What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be going over Teladoc Health. This was an investment that I started making in 2021, and it was a very bad investment. So we're going to go through what my thought process was at the time and see where did I go wrong and see what we can learn from that. So let's start off by looking at the stock chart. As you're going to see here, the stock had a major run in early 2021. It went all the way up to nearly $300 a share, right? Well, I did not start making my investment until the stock was $150. So really, it was down 50% from its all-time high. So normally you would think that might be a good time to buy because that is definitely considered a dip in the stock, right? So we're talking about $150 was when I entered my first position in. And from that time till now, I kept lowering my cost basis. I bought shares at 100. I bought shares at 80. I bought shares at 70. And I think I even bought some shares at $35. So the stock is down, what, over 57% in the last year. And as you can see here, I am down 66% or over $3,000. So this is one of the worst investments I made. And we're going to go through why was I bullish on this stock and what was I thinking and what went wrong with this company over the last 2 years. So first thing I want to bring up is Cathie Wood, because at the time, Cathie Wood, ARK Invest, they were very popular and they were one of the big companies pushing for Teladoc Health. As you can see here, Teladoc Health is still in their top 10 investments list. This is their 9th biggest position at the moment. And so that definitely played a part in how I was influenced in buying this stock, because I thought, oh, you know, Cathie Wood and ARK Invest, they know what they're doing. I had some success. I had a lot of success actually following other stocks they were buying, like Tesla, right? I bought Tesla pretty early on, right around the time Cathie Wood started talking about it, and that one played out to be a huge success. And there was a couple others on this list too that I also had some success with, but Tesla was the big one, and Teladoc seemed very clear to me that they, you know, it felt like they were going to be playing an important role in that industry for years to come. But one mistake I made was trying to estimate what the valuation was. So if we go back here, we can see in about exactly 12 months ago, I put out a video on TikTok showing what my price prediction was for the stock, right? And as you can see here, so most of these numbers are taken from numbers they gave out. So that played a part in this. So they claimed that they were going to do $4 billion of revenue in 2024, right? So that's what I based my numbers on, okay? Now, where I went wrong here was using my price to sales numbers. The stock traded up, I think it traded to a price to sales of like at least a 9 or a 10 at one point, right? So I thought a 9 or 10 was reasonable. And sometimes stocks will trade at higher premiums as, you know, as years go by. Like McDonald's is one example. There are certain stocks where they trade at higher PE ratios, or Coca-Cola is another example. And then other times the PE ratios will come down because there's less growth expected. So I'm not sure exactly what I was thinking when I thought the price to sales was going to go from a 6 to an 8 to a 10 to a 12. But back when I made this video, the market cap was around $21 billion, right? So I was expecting the stock to at least double and be a $48 billion company by 2024. And so the first mistake I made was those using those price to sales numbers, because those were not realistic. I should have been more conservative and probably use, like, I don't know, maybe a 4, maybe a 4 to a 6, something like that. So that was mistake one. Problem number two was their numbers. They missed numbers by quite a bit, and so that also played a part. So let's go through my checklist though and get an idea of where the stock sits now. So first thing on my list is the stock trading below a 1-year average? Yes, absolutely. You can see the average is probably, let's see, let me move this. The average is probably somewhere around $50, let's say, or $45. And right now we're sitting at 31. This stock has been cut in half already, you know, multiple times in the last year or two. So definitely not a good chart there. Next up, revenue has been increasing. They've been doing that, so that's good. Net income has not been improving though. Then we're going to get to their price to earnings. They don't have one, but they do have a price to sales, and the price to sales now is very attractive. If we want to look at their current price to sales is 1.8, right? So compare that to the numbers I was using back here when it was trading at a 6 to a 9, and you can see there's a huge difference there. So, and right now, I do believe the stock's undervalued. Well, we're going to get more into that, but I do believe a price to sales of 1.8 for this company, that is pretty cheap. But I think us using an 8 or a 10 price to sales is way too much. Next up, is it innovative? Do they have a moat? Yes, absolutely. This company is very innovative. If you don't know Teladoc, what they do is they provide telehealth or telemedicine services using a technology platform for pretty much people to, instead of having a doctor's appointment, you can do a lot of stuff virtually. And so it's very convenient. Then we're going to look at, is the industry growing? Yes. How I just said, it's definitely a growing industry. The return on invested capital is negative, so that's going to get a no. Number 8, their free cash flow is not horrible. It's not horrible. Their operating cash flow has grown. Their cash position has grown, and it's not as bad as I was expecting. They're investing money, but not too much. At least in 2020, they invested more than 10 times what they were doing for operating cash flow. But in most recent times, it's not that bad. So that's not a huge problem. And they have about 1.2 million or 1.2 billion dollars of debt, $900 million of cash. So it's not perfect, but it's definitely not horrible. So I put healthy cash flow, that's going to get a yes. Then we get to diverse revenue streams. I put no, not really. They only have one business model, really, just through virtual healthcare. And then we're going to look at their equity here. We're going to see that their equity is, let me move this. Their equity has not been growing. This is part of the problem. So we're going to get into this in a second, but 2019, they had $1 billion of equity. It went to 15, then to 16, and now we're back down to 6, right? And one of the big parts of that transition was their investment in Livongo, which is another health device company. And I remember when this came out, they paid $15 billion for this company. So right now, this company's valued at $5 billion. So you can see that's, something didn't match up there, because why did they pay $15 billion if the company is, first of all, they probably overpaid because that company was not bringing in enough revenue for how much they paid. And now this stock's trading at a $5 billion valuation. So either this company is super undervalued and it should be trading at 3 or 4 times today's price, or they totally overpaid for it. And I think it's probably the second one. So next up on the list, the equity is over 15%. This is actually interesting. They have $6 billion of equity, how we just said, and the valuation is $5 billion. So you're actually getting more equity in the business than you are when you pay at this price. So that's pretty attractive right there. Share count decrease, no, it's awful. As you can see here, they're averaging 22% a year in increasing their share count, mainly because of this point in the fall of 2020, they nearly doubled their number of shares. So things like that are not good for the stock. Are insiders big money interested? Yes. Howie said ARK Invest is this is one of their biggest positions, so that's going to get a check. Respectable management, I'm going to put a no. For one, this company has been around for a while now and there's been no improvements in their net income. Number 2, why did they pay $15 billion for Livongo? That was not a smart move. Next up, is the cash more than average income? Yes, they have $0 of income and $900 million in cash. So that's an easy yes. Not necessarily a great thing though. Number 16, there's no dividend. And number 17, yes, the company just reached over 20 years old. This company was founded in 2002, so it's now 21 years old. So then the other things I wanted to go through were, one, the Livongo. So the score though for this is a 10 out of 17, so it's not considered a buy. the first thing was Livongo, and the second thing was that their equity is higher than the market cap. So right now it is undervalued. The company should be at least $6 billion, if not probably a little bit more. I mean, this still is considered a growth company, right? Because if we look at their numbers, now a lot of business got brought into 2020 and 2021 because of the pandemic. Yes, that's true. But look at this company is expected to grow 18% this year, 13% next year. So those are still pretty good numbers, but nowhere near what they were saying in their report. If we go back through this video, you can see, yeah. So they were a year ago, they put out their numbers. They were expecting to grow 25 to 30% a year. Well, they're doing less than half that right now, right? Those numbers got cut in half. So that's where the real issue is here. That's why. Okay, let's see. So back then, it was trading at a PE ratio of, a price to sales ratio of somewhere around an 8, right? Let's say a 7, 6 to 8. Let's say it was around a 7. It went up to a 9, but let's just say 7. Well, if they're expected to grow half now of what they were saying they were going to do, the price of sales should probably be like a 3, right? And right now it's at a 2. So in other words, the fair value for this company is probably somewhere around 7.5 billion. That's probably where the fair valuation is. Right now it's at a 5. So I think $7.5 billion is a fair value for this stock. And as for what I'm gonna do, I don't know. It's tough because this stock could easily split in half again, and I can lose, another $1,000. But the stock can also double, right? I think there's a equal chance that the stock can double and go to $60 a share. So I don't know. Maybe I'll sell some shares soon. But lately, for the last couple months, it's been hovering around this $30 mark. So we'll see what happens. I still believe in this stock for the next couple years. The valuation just got way ahead of itself, and they probably another thing management did wrong was they probably way overestimated how much they were going to grow. That was another issue. So the lessons we can learn from this are, one, you need to be careful with what type of price to sales you are using for your models, because just because the stock was trading at a 9 or a 10 price to sales doesn't mean that's the fair valuation. When this stock was $300, it's not smart to look at that, or even down here and say, okay, the stock was $200, so that means if it's at $150, it must be super undervalued. Well, that's not always how it works. You got to look at how much are they growing, what type of numbers are they doing. And in this case, they did dramatically overestimate how much they were going to grow. And that's their fault. So it's their job to be a little bit more conservative with those numbers and give investors a better idea. So that's one part of it. And then it's also on me to interpret that information and get a realistic idea of how much are they going to grow, right? Or how much money are they going to make? So, and when this company gets closer to profitability, that is going to make a big difference. They are inching closer year by year. That will make a big difference too. But for the time being, you got to be conservative with what price to sales numbers you're using, how much money do you expect them to actually make, and what price you are paying for. Another thing was, since this stock had its run in a time when growth companies, especially ones that ARK Invest we're talking about, were all hyped up, right? A lot of stocks like Zoom, not Palantir, what's it called? I forgot the name of it, but it starts with a P. A lot of these stocks they were trading had huge runs, right? Or Peloton, that's what I was thinking of, Peloton. These stocks had huge runs during the pandemic, and that you don't want to anchor your price to where the stock was trading at in the past. So that was another mistake I made. You just got to be, and this is a money-losing company, so you got to weigh that into it too. You got to be very careful with money-losing companies, especially when they've been in business for over 20 years. So those are the things we can learn here. The other thing I always say is I learned that if we go back to the number of shares I bought, I was buying shares every like 5% the stock dropped, like 150. I started at buying at 150, then it went to 140, 130, 120, 110. And I was buying shares every single time it dropped, $10. That was a mistake. You need to be more disciplined with how often you're going to buy shares or at what price points. So like if you're down 4% or 6%, that is, you don't need to scoop up a bunch of shares at those prices. Wait till the stock falls 15 or 20% from where you bought, then start buying. Buy a little chunk. Then wait till it falls another 20% to go buy your more to go buy your other shares. That's the other place I went wrong. So those are the main lessons I learned during this process. And I hope you learned something from today. So thank you for watching, and I will see you in the next